First of all, reporter ready? I can't hear you. Okay.
Thank you.
This is the New York Fire Department Pension Fund Investment Meeting. Today is 12/13/2013. It is 10:22. We're in the New York City Controller's Office, 1 Center Street, room 530, New York, New York. We need a roll call of trustees.
Ms. Janice Emery? Here. Mr. John Wooten?
Yeah.
Mr. Justin Hall? Here. Mr. Stephen Cassidy?
James Levin, Steve Cassidy, County.
And Mr. James Levin?
Here.
Mr. Robert Straub?
John Kelly has Bob Straub,
And Mr. John Kelly?
present.
Mr. James McGowan?
Here.
Mr. John Florina?
Here.
Mr. James Ramonda?
Present.
Mr. Sean O'Connor?
Here.
Commissioner Douglas White?
Here.
We have 24 votes and a quorum. We may start the meeting.
Before we start with the public agenda, I just would like to introduce the Controller, John Liu. Say a few words.
Well, thank you, Mr. Chairman. Good morning, everybody. Good morning. I'm delighted to see all of you here this morning. It's hard to believe that the last time I attended a fire pension meeting was almost 4 years ago. And it's gone by very quickly. And I wanted to take this opportunity to attend this meeting as one of my last meetings as New York City Controller. It has been a wonderful 4 years. Over the past 4 years, I'm proud to report some good numbers. We have saved about $5 billion for our audits and contract reviews, as well as refinancing of outstanding debt. We have helped create thousands of jobs by accelerating some of the city's capital construction plans at low interest rates. And of course, working with all of you, we have earned pretty good returns on our pension funds. These numbers are not necessarily just for the fire plan, but it's not that far off. Are we still up over 150 billion in total, Seema? Let's start crossing all our fingers and joints for the next couple of weeks. But I know we don't have numbers for this fiscal year. But for the past 4 fiscal years, I can safely say we are up 58% in cumulative investment returns. In 2010, it was 14%. 2011, we had 23%. Didn't hear much about those 2 years. In 2012, we earned 1%, 6% less than the assumed actuarial rate, right, Bob?
Yes.
And I got tons of news coverage about that one. And then it went quiet again as we earned 12% in fiscal 2013. So in any event, it's been a wonderful ride and a privilege working with all of you on behalf of our New York's bravest, and as well as with the trustees of the other funds. And on a personal note, I will say that I am far beyond anything I imagined would happen in my lifetime. Growing up in New York City as an immigrant, never expecting that I or even someone like me could run for office, let alone get elected New York City Controller and actually run for higher office this year. It is an amazing city, a city that I owe a debt of gratitude towards, and I'm not going away anywhere, going to keep giving back in every which way I possibly can. Certainly looking forward to seeing many of you and working together in different capacities for the betterment of our great city. And so with that, and I also certainly want to thank my friend and mentor, Bob North, who's been our trusty actuary. He gets it from the left, he gets it from the right. Sometimes he makes nobody happy, but he still does his job. And I always say this, not to make him feel old, but when I was studying for my actuarial exams, I studied Bob North quite a bit. And he still is a thought leader in the practice to this day. So with that, Mr. Chairman, I thank you for the indulgence. And I thank my staff, Seema, for taking the reins, and the rest of the staff for doing the great work that they've been doing. And with that, I turn the floor back over to you, Mr. Chairman.
Thank you.
And if there aren't any questions, may I be excused?
Before, if I may have the floor before you, I'd just like to thank you for your leadership and always conducting yourself with the utmost class and putting together a great team here. We really enjoyed working with you, and we wish you luck on behalf of UFA in your future endeavors.
Thank you, Jimmy. Thank you.
Any other comments? That's it. One more thing, I don't have a limerick. That's it. Actually, I think I can speak on behalf of Val Hagan and the fire officers. Okay, we just want to, thank you for, being a friend, and actually we wish you nothing but the best. And again, I just wanted to say thank you very much, guys.
Thank you, Jim.
And if I might, I'd just like to say thank you very much for your kind words. No, I don't feel that much older. I've been working on the old part for a long time. But one of the things that having an actuary as the controller has made me think about and try to up our game all the time, because when I visit you, we have very interesting discussions at a level that are not typical of my discussions with elected officials, and I want to wish you the very best in your future endeavors.
Thank you, Bob. All right.
Thank you.
Thank you, Mr. Chairman. Have a wonderful meeting, everybody.
Okay, we're going to start with the public agenda. Seema? Is that right?
Okay, so we're going to start with the quarterlies for September, and I'm going to turn it over to Martin to get us started.
Yes, so hopefully everyone has a copy of the fire quarterly for September. And you'll note when we go through the returns in just a moment that this is a very different quarter than the prior quarter. And that's because we saw a massive rally in risky assets as the financial markets calmed down from the concern over the markets, concern over the Fed's tapering comments. You'll see as we go through, most of the risky assets, all of the risky assets did well in the quarter. In fact, U.S. equities did more than 6% for the quarter, and for the one-year period, more than 20%. Non-U.S. equity, EFA, did more than 11% just for the quarter. And even emerging markets, which were negative for the year, were up more than 5%. For traditional fixed income, because of concern over interest rates, while interest rates did inch up long-term rates, results were roughly flat, slightly positive, but still negative for the one-year period. But on the more equity-sensitive, risky assets, such as high-yield convertible bonds that are more equity-sensitive, we saw very strong results. So if you turn to page 8, you'll see the sum of this. And I do want to draw your attention to the number on the top left, which was the total value of the fire portfolio as of the quarter, which was, at this point, a new high. Seema is going to go through October in just a moment and a hint of November and where we are. So you'll see some even higher numbers going forward as we inch towards 10 billion. But the quarter on the left, this is one quarter, was 522. That's a very, very strong quarter. We'll show you again numbers for October and preliminary for November. And that was also 100 basis points ahead of the policy benchmark. We'll go through explaining why that was. For the trailing one-year period, results very strong on an absolute basis, as was the three-year number. For the one-year number, over 12%, nearly 13%, ahead of the benchmark, and for 3 years, over 10% behind the benchmark. And again, we'll go through those attribution items in just a moment. Pages 9 and 10 go through the asset mix. We went through this last month. We'll have an update for you for October, but just in sum on page 10, it shows where we are on the top, where each asset class is invested, and we are kind of running out of colors. But on the bottom, you'll see the obvious things that stand out, which on the left in green were overweight U.S. equities, and in the middle in blue and in light purple were underweight Core Plus 5 and TIPS. So how did we do, breaking it down a little bit further on page 11 for the quarter, outperforming by over 100 basis points and on an absolute basis doing over 5%. The overweight to U.S., and this is a theme here, the overweight to U.S. equity, the underweight to core fixed income, investment grade fixed income, and the underweight to TIPS all three of those added value as the equity markets rallied, and fixed income markets, as you'll see later on as we go through the slides, on a relative basis did not do as well. Any cash that we held was detracted from returns, but the cash levels were generally low for the quarter. For the management effect, you'll see, was also very strong, and Seema is going to go through that in a moment. U.S. equity was mostly responsible for that. For the year, similar theme, but the numbers are on an absolute basis very high, over 12, nearly 13% for the year, over 170 basis points ahead of the benchmark. The allocation effect was even more pronounced because this was a full year of being overweight U.S. equity, and we were overweight U.S. equity for much of that time, near the top of the range, and 4+5 in tips also at the bottom of the range, and those underperformed, and you'll see for the year they actually had negative returns. And cash, any cash that we held would have been a detraction. For management effect, again, U.S. equity did very well, and that was the main driver for the positive number there. For the 3-year number, the allocation effect was roughly flat, slightly negative, and the biggest detractor there, the biggest number of anything was the cash that was held, which goes back now to 2.5, 3 years ago. The management effect was negative, and most of that is from private equity, as we, I think, talked about last quarter. We have a summary of those, each of those asset classes and those numbers on the next 2 pages. So I want to draw your attention to page 16 on how you did versus other large public funds, here defined as funds over $1 billion. So on the left is the quarter. The 522 puts you in the top, above median in the second quartile and 38th percentile to be precise. You're the blue dot. I have trouble seeing. And similarly for the 1-year and 3-year and 4-year numbers, you were in that second quartile as well, but 5-year number as well, and for the 7-year number right at the median. So you're in the second quartile, doing better than the median manager for most of those time periods. If you have any questions, I'd be happy to take them. Otherwise, we'll have Seema go over the equity numbers.
Okay, thanks, Martin. So if you turn to page 20, these are your U.S. equity returns, so about 38% of the total funds. If you look in the quarter, as Martin was describing earlier, the Russell 3000 was up a strong 6%, and Fire's portfolio did even better than that. So up over 100 basis points over the benchmark for the quarter, and then also in the trailing 12-month period, even stronger than that, over 300 basis points of outperformance. So strong absolute returns for the index being up close to 22%. That's a big number for U.S. equities. And then Fire's portfolio being up basically 25% during that 12-month period. So a number of things have helped add to that outperformance. The allocation helped us, meaning where we were overweight small cap, overweight mid cap, and underweight large cap, which was a decision we all made and the board approved, which has helped a lot in this period. And that's versus the Russell 3000. And then the active managers did well. So your small cap managers outperformed, your mid cap managers were in line to slightly outperform, and your large cap managers outperformed. So our allocation plus the managers did well for Fire, which is good. Turn to the next page, 21. This is a snapshot of where the money is invested in U.S. equities. And as you know, more than 75% of the money is run passively in the U.S. Versus active. And so if you look at the 3 columns, the index return, the actual return, the difference column, I'll just point out a couple of the numbers Martin referred to earlier. So the Russell 3000 index, which is the U.S. market, up over 6% in the quarter. But then you look at the Russell 2000 index, so that's a small cap index, that's over 10% for the quarter. And then the mid-cap S&P 400 index, a few rows down from that, was up over 7.5% in the quarter. So there you see that allocation effect helping us. And then in the difference column, you'll see some of these active managers did quite well for the quarter. So if you then turn to the international allocation, which is on page 28. So about 16% of the total funds for fire. If you look at the pie chart on the left there, it's kind of just the reverse of what we have in U.S. equities, where in international you are much more active than you are passive. And then if I just point you to those three columns, the index return, actual return, and the difference column, some very strong numbers here, much stronger than in the U.S. markets. So if you look at EFA passive, up close to 12% in the quarter. Scroll down a little bit to passive EM, that's closer to the U.S., but up close to 6%, which is a very good number given that emerging markets have had a more difficult time. But then I want to point you to the EFA small cap number. As you might remember, the EFA search that we did, we added an allocation to small cap, which we thought was a good idea to add diversification, add some higher risk adjusted return. You can see there in the quarter, EFA small cap was up close to 15%. So a very big number. So it's a good allocation decision there. And then if you look in the difference column, you can see there are a few of the active managers in these groups have done well, some offsetting some other categories. If you then turn to the next page, 29, this is the EFA markets in more detail. So about 10% of the total funds. And again here, strong absolute return numbers. But if you look at the quarter, the trailing 3 months, fiscal year to date, it's the same. So the purple bar is the overall EFA portfolio for fire. The blue bar is just the active piece, and the yellow bar being the index. So in the quarter, the active managers did almost 100 basis points better than the index, which is very good. So overall, again, up close to 100 basis points of outperformance in the quarter. And again, these numbers up close to 12% for the quarter. Then if you look in the trailing 12 months, the index is up almost 24% in the trailing 12 months. The active managers, now you might remember, we added these new EFA managers only in the midpoint of this year, so we hope to see good performance going forward from them. But that's why you'll notice that some of these numbers aren't as quite as strong as you saw in the quarter in terms of outperformance, but still strong absolute return numbers. If you then turn to page 35, it goes to the emerging market portfolio. And here, about 6% of the total funds. And what you'll notice right away is that the absolute numbers are a lot lower than what we've seen in the U.S. and the developed markets in EFA. In the quarter, the index being the yellow bar is up close to 6%. Again, the active equity bar is the blue one, and the purple one is the overall portfolio. So very close to the index for the quarter. And then if you look out in the trailing 12 months, the numbers go down even more because, as you know, the emerging market equities have had a much more difficult time during this period. So the index being up about 1.3%, the yellow bar, and you can see in the purple bar, we're up a little bit more than that in the portfolio. To turn to then page 37, we'll go through hedge funds. It's currently about 3% of the total funds. We're making our way toward 5%. Which is the approved allocation. And so if you look in the quarter and then the trailing 12 months, what you see here is we're trailing our benchmarks, and reason being, as we've talked about a lot lately, is that our strategies that we're invested in we're still tilted more toward the diversifiers, global macros, these types of strategies, and in a very equity-sensitive market that we're in right now, where the equity markets have done so well, we've been working hard to get more event-driven managers, which are more equity-sensitive. So we have a few of them, but not enough to be in balance, which, as you know, we've been working toward. So it's a balancing issue of where we are today, and the strategies that have done better are those that have been more equity-sensitive. And we just don't have as much of that yet in the portfolio, but that's what you'll see going forward in terms of what we think we'll start adding. So if there aren't any other questions for me, I'll turn it back to Mark.
Page 39 shows the overall and overweight the spread sectors, mortgages and credit. And in this particular quarter, if you look at either the index or actual returns, you'll see that the government sector was negative because interest rates rose slightly, long-term rates. So adding spread on top of that did help. So as a result, being underweight the worst performing sector and overweight the better performing sectors on its own helped, and that's why the allocation effects on the side on the right are positive. Although 2 of the 3 sectors underperformed, while that's the case, of the 12 managers, 8 of the 12 did outperform. So the underperformance, as you see, is 2 basis points in one case and 7 in another. But putting it all together, on page 41, I cannot compete with SEMA's numbers. The numbers here are a different scale, and on the left, the returns for investment grade fixed income, core fixed income is 0.72%, but that was ahead of the benchmark by 9 basis points. For the year, and this is very important, for the year, the number is negative, minus 140. But if you look at the index, the return was worse than that. In fact, we were 92 basis points ahead. While it's never a very good thing or a happy event to tell you that we lost money, but hey, we did better than the benchmark, the reality is when you have very low returns and you do 92 basis points ahead of the benchmark, that's where it really helps. And that's in fact what happened. And if you look at the 3-year number and the 5-year number, the managers have done well in also relatively low return environments. So when you have flat returns or potentially negative returns, if managers can add value above that, that can be very helpful. And that's in fact what has happened. If you take a look at the TIPS portfolio on the next page, page 42, similar story of very modest returns for the quarter of less than 1% and slightly ahead of the benchmark. And for the 1-year period, also negative returns. In this case, worse negative returns because this is more akin to the Treasury sector, the sector which had more negative returns because there's no spread involved here. And so the returns were negative 584, 26 basis points ahead of the benchmark. And again, being ahead of the benchmark in these environments is very helpful. The returns in longer periods were modest, but still nevertheless consistent with what our expectations were long term. And by the way, for the quarter, all 3 of the managers did in fact outperform. High yield did in fact live up to its name. For the quarter, the return was 2.34%, and that was 46 basis points ahead of the benchmark shown in yellow. That's the primary benchmark. And for the 1-year period was up 6.5%, and again, that's 77 basis points ahead. The 3-year number is 8.5%, slightly behind the benchmark, but that will be, if you'll remember, we did a search about a year ago, and a transition about a year ago, so some of the older managers that weren't performing well are running off, and some of the newer managers and managers that have been performing well are rolling back on. But nevertheless, the longer-term numbers are excellent. In fact, if you look at the 10-year number, well over 8% and nearly 100 basis points ahead of the benchmark. Bank loans, we don't have a chart yet. We'll have one next quarter, so we have meaningful numbers to give you, but I can tell you that the return for the quarter was 1.67 versus 140 for the index. Convertible bonds, very equity sensitive. The returns look very strange here, and I'll explain it to you. In blue are the returns of our manager, it's a single manager, which was 367 positive, which was higher than most fixed income because it's equity sensitive. Yellow is the primary benchmark, which was 737, so we were well behind that benchmark. But if you look at the purple number, what we show here is the benchmark of, since this is a single manager composite, it's the benchmark of the individual manager, at least for the fiscal year to date column. And the manager, in fact, did outperform, and in fact outperformed all 3 years. You will remember, going back in time past a year, we did a bit of a restructuring in convertible bonds. So while the 5-year number, we're underperforming that number, you will see the 12-month, the 1-year, and the 3-year number outperforming the custom benchmarks. And while we are underperforming the overall index, that is not unusual in a bull market, and I'll give you one very quick example, and that's because of the index composition. We've been talking to the index providers and the managers about this, but the index providers have not changed it. Convertible bonds can be equity sensitive. So convertible bonds give you a bond-like return plus an equity upside. When the upside kicks in, when the underlying equity does well, the bond price really shoots up and does well. So you can have a bond that's 1, 2, 3% in the index, and if it really does well, it can beat 10% of the index. And managers in portfolios, in institutional portfolios, will not say that it's a prudent thing to do to own 10% of anything in a portfolio. But nevertheless, it represents 10% and it's doing very, very well. So in a very strong bull market, which we've seen, it's not unusual to see results like this. Over a market cycle, it should end up being reversed out. And we see that flattening in the 5-year number, and part of the underperformance in the 5-year numbers I mentioned was the restructuring that we did recently.
Can I just add something? And then at the bottom of the page, you can see the planned standard deviation over 5 years versus the benchmark there. Versus that broader benchmark, the portfolio the managers put together has had less volatility than that broad benchmark. And a lot of that, I think, we haven't had a real down market since then, but that's something where you would expect the managers to outperform. So it's a very credit-sensitive selection process, and I think, we say this with high yield too, you should be comfortable earning around the benchmark return or a little bit less than that if your manager's delivering 75 or 80% of the volatility of the benchmark, because the benchmark is an imperfect beast. We use it to compare, but it's not.
And especially in convertible bond land, the overall expectation here is 75% of equity upside, and a third of or 40% of the volatility. So and that's what we've gotten over time. So that explains some of the returns. We could talk more in the executive section if you wish, but just wanted to give you an explanation as to why the numbers look like this. Opportunistic has done well on page 45 for the quarter. Strong number of 334, ahead of the benchmark for the 1-year number over 15%, ahead of our 10% primary benchmark, and for the 3-year and 5-year numbers ahead as well. Although the 3-year and 5-year numbers have items that are rolling off, and the newer partnerships will be rolling on and will be more meaningful going forward. And I'm going to turn it over to David Morris, unless you have questions for me. I'm going to turn it over to David Morris for ETIs.
Turn to page 13 of the order. For the third quarter, the PPAR program performed well, beating its benchmark. Turning to pages 7 and 8. In the third quarter, the pension fund purchased more than $277,000 in loans to create or preserve 279 units. The pension fund also started to make use of its newly expanded geographic target area. And in that quarter, Fire made new commitments totaling $526,000 that will cover 276 units. And the market value of the fund's PPAR portfolio is $2.2 million. In this quarter, the pension fund participated in an investment in an ambulatory care facility at a local hospital. And this new facility will provide a number of services to the community and is expected to generate in total 5,200 jobs, all of which will be union labor.
So then we'll go on to private equity. So I'm going to do page 18 of the book. Start there, rather. 18. So, okay, so if you look at the table, you'll see where we are for the second quarter of 2013. And you'll see that we have in your portfolio 93 managers, which represents 143 funds. In total capital committed, you have $1.36 billion committed. You've given out $821.6 million and gotten back $527.6 million in total distributions. Your market value for the portfolio is $593.1, and the total value is $1.1 billion. In terms of your performance, you'll see further below that your your total value multiple is 1.36 times, and your IRR is 1.3%. I'm sorry, 10.3%. If you look at page 19, you'll see how you performed against the benchmarks. You'll see that bar chart there. And your 10.4% underperformed slightly against the Russell 3000 plus 300 basis points, but overperformed significantly over the Thomson 1 median IRR, which came in at 4.1%. So if you turn to page 29, you'll see all the commitments that we went to during that quarter, the second quarter of 2013. There are 7 there that are listed. 3 of which were core investments and 4 of which were the Emerging Manager Program. In total, that came out to about $100.3 million in commitment. And then subsequent to the quarter close, we did another $5 million, and those are both into Emerging Manager funds. If you turn to page 32, let's talk a little bit about which strategies are performing for you in your portfolio. And you'll see the one leading in terms of portfolio performance is secondaries, coming in at 20% IRR. And that's led by some great names that you guys have in your portfolio, both existing and new. In particular, you've got Landmark, you've got Lexington, you've got AXA. AXA was brand new. And it's worth noting that Lexington is back in the market. You may see them in January. A great performer for you so far. And then it's also worth noting that AXA has since spun out of their mothership or mother company, whatever you call it, AXA, and are now called Ardian. So you may see them coming back as well. They've been phenomenal performers in your portfolio. The second strategy that's performed very well for you was growth buyouts, which came in at 18.3%. And one of the key leaders there in terms of performance has been Vista, which has been an existing relationship for you all, but then also we've re-upped with them in the past couple of years and also gone into them from an emerging manager. So it's great exposure for you there. The third best performer was Special Situations, which came in at 15.2%. And again, a mix of existing and new relationships. In terms of existing, you had Ares that's been doing a great job for you all. And then Platinum has been a new relationship for you all, and they're a 2012 fund that has already turned a great deal of the fund back in distribution, so excellent performer. And then the fourth strongest performer for you there was buyouts, which came in at 12.2%. And of the buyout strategies, the best performer for you there was the large buyout, which came in at 26.7% IRR. And again, those are great names that you have in your portfolio, the Carlyles, the Apollos, and the CVCs of the world, all of which we have re-upped over the past year. If you turn to page 37, I'll leave you on one of the more important slides here, which shows all the capital coming in, all the capital going out. It's the quarterly cash flow activity. You'll see the charts, the bars on the top are your distributions coming back, on the bottom your contributions, and then that line is the net cash flow. And you'll see that for the second quarter of 2013, you're up at $34.5 million. But if you look at it against the previous years, it's one of the better years you've had in a while. So positive performance, you're at a positive net cash flow, so all trending in the appropriate direction. And that's it for the quarterly report. If you have any questions.
Hi, good morning. So continuing in the same book, in fact, real estate uniquely follows private equity, so that's great because the page numbers are kind of obscured on the right. So I'm going to refer to the page numbers on the bottom so that you'll see the first page of the real estate performance report has page 1 down on the bottom, and I'll be referring to those page numbers as I continue to give you a review. So if you start on 45, you'll see that the real estate report immediately follows. So for the second quarter, the fire real estate portfolio, just want to give you just a couple of brief notes on market conditions. So I think we're finally seeing some traction as it relates to real estate recovery on a global basis. There's an improved investor sentiment with the U.S. leading the way. Now, you know, we talked about the U.S. real estate recovery. It seems to have started, then stopped, then started, then stopped. And I think U.S. is going to be leading the way globally for the real estate recovery as we finally have some traction. Some other regions that are showing some early signs of recovery are in Europe, and you know we've talked about and brought some investments to you from that region. And I think one of the ways that we can tell whether or not this trend is really substantiated is the volume of transactions around the globe in commercial real estate. For that quarter, for the second quarter, was $120 billion worth of real estate deals transacted, and that's a 10% increase from the year before. And in a few weeks when the year is over, it's estimated that there'll be close to $500 million of real estate changing hands on a global basis. Initially, we talked about the interest by investors in real estate as being in core, looking for stabilized properties, very strong income and very prime markets. Well, those assets are fully priced right now, and investors are now looking for yield by pursuing value-add strategies. They're looking in secondary cities, and some of your real estate managers, which, you know, about 30 core plus and non-core managers are doing exactly that. So if we kind of turn our attention in particular to the fire portfolio, as you know, there is a 5% allocation to real assets. And in terms of real estate, there is $340 million of value of real estate assets in the ground right now for the fire portfolio. We have about $100 million of commitments that we have yet to fund, and so our exposure to real estate is $440 million, and there's about 38 investments at this particular point, and about close to 30 managers executing those strategies for you. So we kind of look at the performance for the quarter. We find that fire has slightly outpaced the benchmark, turning in a return of 4% for the quarter versus the benchmark of 3.9%. I apologize, the graph on the right, the shading is a little bit off, so we'll correct that next quarter. But just to continue to tell you about your performance, 13.6 on a one-year basis, again outpacing the benchmark. 3 years, 15.8 again, ahead of the benchmark. For longer periods, you see the effect of the global financial crisis, and we're a little bit under there, but we continue to have a very strong start on a post-recovery basis. The IRR for the program right now is 3% at a 1.1 times multiple. And I keep talking about the benchmark, and that kind of relates to the way our portfolio is constructed. Our benchmark is Odyssey, which is a time-weighted core real estate benchmark in which we've added a premium of 100 basis points because we have a blend in our portfolio, both core, core plus, and non-core strategies. And there's further detail in terms of compliance on page 8. Just talking about the number of commitments that we made second quarter. We made a $10 million commitment to an industrial fund during that quarter, and on a post second quarter basis, we have since closed that deal at $10 million. We've also closed on the Superstorm Sandy deals, also closed on the Blackstone Europe 4, where Fire committed $20 million. That deal is now closed. And Divco West 4, the follow-on of the very strong Divco West 3, has closed for Fire as well. So if we turn over to the following page, we're just going to take a look at our exposure to real estate, which I mentioned was about $440 million. And as we kind of look at it in terms of how the portfolio is diversified by strategy, we are right now about 35% in core plus strategies and 65% in non-core strategies. And as you know, we try to keep that balance in terms of our IPS at no less than 40%. So you'll see that the core plus is slightly under, but you'll recall that In previous years, right after the downturn, we made a tactical decision to overweight non-core because that's where we found the opportunities. And the core sector, as I noted before, became fully priced very quickly. So right now, we're at 65 to 35%, but that will kind of even out over time as our managers deploy the capital. And for the quarter, you have, we contributed to the managers $9.7 million because they are active in the market. We also have managers that are harvesting. They're selling those assets, getting top dollar, and we received back $8.5 million for the quarter. The following page, which has page 3 down at the bottom, takes a real granular look at the quarterly performance, again by strategy, trying to address which of the managers in each sector, the core sector versus the non-core sector. So we have 11 funds, 11 investments in the core plus sector, which for the quarter delivered a return of a net 3.5. And we have Prologis and Heitman are the managers that kind of drove that return for the quarter. In the non-core sector, we have about 23 investments, and together they delivered a return of 4.5. On a net basis, an outperformance there again was Divco West 3. Going on to the next page gives you a nice visual, again, a very granular look at the performance for the quarter. Those bars on the right at the top show you who your outperformers are. And for this particular quarter, it's Divco West 3 and Angelo Gordon and Blackstone. And there's some highlights of the activities for the second quarter for those funds. I would note that both Divco West is a smaller manager. Of course, Blackstone is a larger manager. And you know that one of our objectives is to create a pool of managers for you that deliver outsized returns over cycles, whether they be large or small. And we've been able to do that over the past 3 years in identifying, small entrepreneurial groups like Divco West and large asset allocators that execute very successful investment themes like Blackstone. So this graph is also available for longer time periods for the 1 year and the 3 year. You'll see that on page 10. The following page on page 5 shows diversification of the portfolio. In real estate, we try to manage risk through diversification, not only through managers, which we just talked about, but we also try to diversify the portfolio in terms of property type and geographic diversification. And we're very pleased with the direction that the portfolio is going. And there's some further detail on market conditions and our compliance report card and other things. And if you have any questions or comments, I'd be happy to take them.
Any questions?
So does it make sense, since we're doing the quarterlies, to do the VSF quarterly before we do the ad hoc monthly?
Yeah, sure, it's no problem. Okay, we'll have to come back to the public session. So we have to close the public session. We need a motion to move out of the public session and close it.
We're still in public though for the VSF, right? For the performance. We're just moving out of the main fund going to the VSF, correct?
No.
We're not moving out of public to go to the VSF.
Still a public, yeah.
Right.
It's still the public.
Yeah.
So why don't you call it,
Okay.
maybe the 5% of the 5
Okay.
VSF? Does that make sense?
Yeah, I think so. What are we're gonna, but we still, we need to, okay, we'll call, we need to close the meeting at least for now, but we need to do
I'll make
a
a
roll
motion.
call for the VSF.
Make a motion to move out of the fire pension meeting into the fire BSF meeting.
Okay. Roll call, please. Thank you. Oh, that's right.
Ms. Janice Emery? Here. Mr. Zach McKee?
Here.
Mr. James Bevan?
Here.
Mr. Robert Strauss?
Ron Kelly has Bob Schraub, proxy.
We have the full notes in the form of Mr. Mead.
Okay.
Fire has, UFA trustees have reviewed the quarterly booklet, and that's satisfactory for us. No need to go through a report.
Okay?
So there's a motion to adjourn the,
Motion to adjourn the fire VSF meeting?
And we're going to open up the fire officers variable supplement fund. Need a roll call?
I'll second it.
Motion passes. Do we have a roll call?
Ms. Janice Emery.
Here.
Mr. Zach McKee.
here,
Mr. James McGowan.
Yeah.
Mr. James Amanda.
Here.
Earl Quinn, and Mr. Lee.
You have the quarterly report here?
you want to make a motion to accept the, fire season, variable supplement fund, as a
Is there a second? Was there a motion? There was a motion, second?
Second.
Well, you're just noting it, I guess. You don't need a motion. That's what she's saying to you. You're just noting it. Okay, is there anything else in this part of the meeting? No?
we have nothing further, Mr. Chairman.
I can't hear you,
We have
Sam.
nothing further, Mr. Chairman.
Okay, so then I think we should go back to we did a motion to close this part of the meeting. We go back to the public session that we're in all.
So moved.
Okay, second. Any opposed? Hearing none, motion carries. So we have to discuss, I guess, the October monthly performance review. Is that it?
Okay, so everybody has their monthly performance book. If you'd turn to page 34 in the monthly performance book. So on page 34 are the October numbers. We'll just go through those quickly. They were very strong numbers. You can see here the Russell 3000 up over 4%. The EFA markets up over 3%. Emerging markets up close to 5% in October. Core plus 5 up over 1%. The high yield index up close to 2.5%. And tips up about 55 basis points. Now, before I go through the November numbers, which we have for you, the quick update really is that it was a bumpy ride. You had the U.S. and developed markets positive for the month. You had emerging markets slightly down in equities. But you might remember you had the European Central Bank on the one hand surprising and cutting rates. And on the other hand, you had strong U.S. economic numbers come out. And so there was question marks again about when is the Fed going to start tapering its bond buying program. And so that led to the bumpy ride, although overall it was still up a little bit. So that was a good thing. So in November, if you just want to write these down, so you have them, the Russell 3000 was up 2.9%. The EFA markets up 81 basis points. The emerging markets down about 1.5%. Core plus 5 down about 65 basis points. High yield was up about 32 basis points. And then tips down 1.2%. But overall, when you net that out, we think we're up in November about 1%. Good. If you turn to page 30, it shows our asset allocation and how fire's set up. So as Martin pointed out before, and you see here, the green bar to the left, we're showing over the range in U.S. equities, so overweight that. And and the blue bar to the right showing underweight to core plus 5. And what we did in November is we sold U.S. equities, we took advantage of the strength in the markets, and we bought in core plus 5, we bought investment grade with those proceeds, and so now we're back within those ranges, so we're good there. If you then turn to page 35, this is the contribution to returns. So you can see here in the far left bar, the 1 month number, FIRE was up 2.63%. And a couple bars over, the fiscal year-to-date return now through October is up about 8%. It's very strong. If you add in November, which we think is up about 1%, FIRE is now up nearly 9% fiscal year-to-date through November 30th. So very strong number. Good. So then if we turn to page 27, shows the last 12 months of market values. And so during this time period, FIRE is up about $1 billion over this 12-month period. And you can see here as of October 30, FIRE was at $9.85 billion. And I can tell you as of December 10th, FIRE is now at $9.87 billion. Higher is good. Next, page 28 are the 10-year numbers. And the 10-year return now for FIRE as of October 31st is 7.65%. And again, the dollar figure for the total plan as of 12/10 is $9.87 billion. So very close to $10 billion. And December, again, we're a little bit up and down here and there, given all the same macro things going on. But we have a couple more weeks to go, and so far the fiscal year-to-date numbers are great. If there are any questions, I'll turn it back to Pat.
Any questions?
Unless there's any questions, I believe that Bureau of Asset Management has completed the public agenda for today.
Okay, any questions? All right. So I think that we need a motion to move out of the public session to executive session.
So moved.
Second. Thank you for a second. Any objections? Hearing none, motion carries. We are, I think it's management review.